Let's get some more analysis on Xi Jinping's speech just now, the keynote address at Boao Forum, joined by the University of Hong Kong Professor Emeritus John Burns, still here with us, and also bringing in here in Sydney, Jim McCaughan, who's the CEO of Principal Global Investors. Jim, let me turn to you to get your initial reaction. You're actually saying you saw that address as being less targeted towards Washington, appeasing perhaps somewhat President Trump, but more towards a regional audience.
Yes, I think that President Xi realises it's actually a bit too early to expect a real compromise with President Trump. There's a lot of things being laid out by the president, but a lot of his rhetoric is driven by the midterms in early November and by getting the base supporting him, which is why he's talking tough on immigration, talking tough on Syria and curtailing use of chemical weapons, and talking tough on trade. And I think there's an election cycle here that will mean that this lasts for a while. So the idea that there's going to be a quick fix on this, I think, is unlikely. I read much of that speech as being about cementing China's regional leadership as an open company fostering free trade and development. In a sense, it's filling the gap that was left when the US withdrew from TPP. And I think that that aim of regional leadership as an agent for free change is really, for free trade, is really what was behind two-thirds of that speech.
Well, this is Davos 2017 redux, essentially.
It is.
Speech.
No, it's essentially the speech moved on to the environment we're now in with somewhat different players. I was impressed that he talked about specifically about protecting intellectual property and about reducing the tariffs on automobile imports. Those are both specifics that have already come from the US position on Chinese trade. But I think this one has got quite a long way to go, and I would hazard a guess that it'll be a few months before they really sit down, whether it's at Mar-a-Lago or whether it's at Davos in January. At some point there will be a coming together, but it'll be having negotiated things that are to each side's advantage.
You've seen risk assets seeing a bit of a reaction, a positive reaction to that speech. What do investors do? I mean, do you stay fully invested? Do you take a little bit more caution over the next few months as this continues to play out?
I think it depends which investment sector you're looking at. I think the US private sector is in really good shape. And I think that maybe the government sector is another matter, but the private sector is in very good shape. And US equities, following a few bumps in the last 2 months, are really only on about 17 times earnings at the S&P, which is about in line with the long-term averages. We're looking at first quarter earnings most likely will be very strong. So I would say that particularly on US equities, they continue to be a buy on setbacks. I'm not so sure about some of the other countries where they're more dependent on monetary policy. I'm thinking here of Japan and the Eurozone. I suspect that in contrast to the US, their markets have become, that's Japan and continental Europe, have become a sell on strength rather than a buy the dips. So I'm a little bit more nuanced than I was here, but I think basically keep up to weight in equities, particularly US, remains the right approach.